Chapter 6. Volume and Open Interest. Although price is regarded as the best indicator of potential future price behavior, volume and open interest offer additional evidence to corroborate bullish or bearish setups. Volume and open interest can indicate potential underlying weakness and also function as timing indicators for potential breakouts. 6.1 The mechanics of volume ACTON. Dow theory of volume confirmation. We learned in Chapter 2 that under the tenets of Dow theory, volume is expected to confirm the trend, that is, it should expand in the direction of the pre-existing or predominant trend. Volume is regarded as a supporting or secondary indicator of potential future price action. To confirm the trend, volume should increase as price rises and decrease in any downside retracements. In a pre-existing uptrend, bullish volume action, volume should increase as price declines and decrease on any upside retracements. In a pre-existing downtrend, bearish volume action. When studying volume, the practitioner should always remember two basic principles, which are: 1. A rise in volume indicates that market participants are interested in seeing K price go higher in an uptrend or lower in a downtrend and are willing to buy higher in an uptrend or sell lower in a downtrend in order to participate in K unfolding market action. 2. A decline in volume indicates that market participants are losing interest in seeing the price go higher in an uptrend or lower in a downtrend and are more willing to buy lower in an uptrend and sell higher in a downtrend, if not exiting positions in the market. Notice that in figure 6.1, both rising and declining volume are regarded as bullish volume if both volume and price rise and decline together in a pre-existing uptrend. Conversely, both rising and declining volume are regarded as bearish volume if volume and price move in opposite directions to each other in a pre-existing. This shows that declining volume does not necessarily This shows that declining volume does not necessarily imply bearishness. And similarly, rising volume does not imply bullishness. The bullish or bearish sentiment associated with volume action depends on the direction of the price. In figure 6.2, we observe volume expanding in the direction of the primary. In figure 6.3, we observe volume action that is not confirming the pre-existing trends. Here we see that both rising and declining volume are regarded as bearish volume if both volume and price move in opposite directions to each other in a pre-existing uptrend. This is an indication of a potentially weak or bearish uptrend. Conversely, both rising and declining volume are regarded as bullish volume if Both volume and price rise and decline together in a pre-existing downtrend. Volume confirmation and divergence. This leads us naturally to the concept of volume confirmation and divergence. Simply put, volume divergence occurs whenever volume declines, irrespective of the direction of price. Volume convergence or confirmation occurs whenever volume rises, irrespective of the direction of price. Volume divergence implies that market participants are not interested in seeing prices rise or decline further. As prices rise and volume subsides, traders and investors indicate that they are less interested in participating in the upside move. This is bearish for an uptrend. Similarly, as prices fall and volume subsides, traders and investors indicate that they are less interested. This is bearish for an uptrend. Similarly, as prices fall and volume subsides, traders and investors indicate that they are less interested in participating in the downside move. This is bullish for a downtrend. Volume convergence, that is volume increasing, is an early indication of a potential continuation of the existing trend. Volume divergence, that is volume decreasing, is an early indication of a potential reversal of the existing trend. Volume divergence always indicates potential weakness in an existing trend, whereas volume confirmation always indicates potential strength in an existing trend. In short, bullish divergence can only occur in a downtrend, indicating a possibility of a potential upside reversal in the trend. Bearish divergence can only occur in an uptrend, indicating a possibility of a potential downside reversal in the trend. Potential downside reversal in the trend. In figure 6.6, we observe bullish volume in periods 1 to 10, except in period 5. In figure 6.6, we observe bullish volume in periods 1 to 10, except in period 5, where the volume action was somewhat flat. Periods 1, 3, 7, and 9 display bullish confirmation, while periods 4 and 6 display bullish divergence. Periods 2, 8, and 10 display volume declining during a consolidation. In a consolidation, volume functions as a breakout timing indicator. We observe that at the end of periods 2, 8, and 10, price experiences either an upside or downside breakout whenever volume declines to its minimum for each period. Summarizing all possible divergent and convergent scenarios. Whenever volume and price are declining together, we have bullish divergence. Whenever volume and price are rising together, we have bullish confirmation or convergence. Whenever volume is declining and price rising, we have bearish divergence. Whenever volume is rising and price declining, we have bearish confirmation or convergence. Reading divergence for volume bars, smoothed volume oscillators, and open interest. 1. Non-price based volume oscillators. 2. Price-based volume oscillators. Price-based volume oscillators incorporate price data in their construction, whereas non-price based volume oscillators only incorporate volume data in their construction. It should be noted that reading price-based volume oscillator divergence differs from reading non-price based volume oscillator divergence. Some popular price-based volume oscillators include on balance volume (OBV), accumulation distribution line (ADL), Chaikin money flow, Chaikin oscillator, demand index, Herrick payoff index. Some non-price based volume oscillators include standard volume bars, smoothed volume, detrended volume, rate of change of volume (ROC volume), percentage volume oscillator (PVO). Volume as a timing indicator. Volume may also be used as a timing indicator for breakout. Volume may also be used as a timing indicator for breakouts from consolidations. Whenever volume declines close to its lowest historical level, a breakout is expected. This is because all the buyers and sellers who are interested in participating in the stock or market have already done so. An accumulation of stop orders above and below the consolidation over the consolidation period will act as a catalyst for either an upside or downside breakout once triggered. Hence, whenever the volume is testing a significant minimum or its lowest historical levels, a breakout is expected. We refer to this as a low volume breakout signal. Note that there is no divergence reading during a consolidation. Such reversals as low volume reversals. In figure 6.9, we observe price breaking out from an accumulation after volume declined to its lowest level. We also observed two low volume reversals just prior to the consolidation at timelines 1 and 2. In figure 6.10, we observe three consolidation breakouts occurring whenever the lowest or minimum volume level is tested. Notice an increase. Volume weighted average price moving average VWMA. A volume weighted moving average VWMA may also be created to track overvalued and undervalued stock in the market. Typically, price is considered potentially bullish when it is above the VWMA and bearish when below it. For a detailed calculation of the VWMA, refer to Chapter 11. In figure 6.11, we notice price rising decisively every time it crosses above the VWMA and declining in a similar manner when it crosses below it. We also notice that the crossovers occur at the daily volume cycle peaks. It should be noted that the stock is regarded as undervalued if it lies below the VWMA and overvalued if it is above it. Hence many institutional traders deem it advantageous to only look for buy signals for a particular stock or market when it is undervalued with respect to the VWMA and sell signals when it is above it. Volume buying and volume buying and selling climaxes. A market top or bottom is usually accompanied by either relatively large or extreme volume, relatively low or minimal volume. Here are the four possible scenarios for a top and bottom with respect to volume. 1. A market top associated 1. A market top associated with extreme volume is called a blow-off or buying climax. 2. A market bottom associated with extreme volume is called a sell-off or selling climax. 3. A market top associated with extremely low or minimal volume is called a low volume top. 4. A market bottom associated with extremely low volume is called a low volume bottom. It is important to note that overextensions in volume can signal either a top or a bottom. A bottom. Extreme buying and selling activity generates volume and can result in either a top or bottom. That is the reason why we cannot use the terms overbought or oversold with respect to volume extremes unless we are able to associate volume with either a top or bottom formation. Therefore, although we are able to pinpoint overextensions in volume, it is only possible to identify overbought or oversold levels in volume after a top or bottom has already formed, that is, in retrospect. Volume action and the strength of a price barrier. An indication as to the potential an indication as to the potential strength and reliability of a price barrier may also be gauged from the action of volume at or across the point of support or resistance. Figure 6.18 shows two scenarios for resistance and support. Support and resistance formed at a volume peak are generally regarded as the most reliable and provide the strongest barrier to future retests. This is because even with the large surge in volume, price was still unable to penetrate the barrier. This gives traders confidence that the price barrier should hold up on future retests. Since expectation is everything in the market, this goes a long way to garner confidence in the barrier. Support and resistance formed across a volume deep or trough is considered less reliable since the reason for price not being able to penetrate the barrier is mainly due to a lack of interest or participation at the price barrier. Traders were not interested in taking price through the barrier. Hence the barrier only held up due to a lack of buying or selling pressure. In fact, there are 5 possible scenarios of volume action associated with support and resistance, which are 1. Volume increasing across support or resistance. 2. Volume decreasing across support or resistance. 3. Volume peaking at support or resistance. 4. Volume bottoming at support or resistance. 5. Volume flatlining across support or resistance. Finally, flatlining volume across support and resistance. Finally, flatlining volume across support and resistance does not provide enough information about potential future action of price with respect to the barrier. Filtering volume action. There are numerous ways to filter volume in order to identify the most significant volume action, some of which include employing a moving average filter, a volatility filter, prior volume peaks, volume cycles, Setting up a smoothed volume filter. A smoothed volume filter is simply a moving average based on volume instead of price. To select the most effective look-back period, a simple backtest may be required to identify the amount of filtering that is appropriate for a particular trade setup. Volume filtered inflection points. Many practitioners also use volume as a means of filtering out price inflection points. They only use peaks and troughs that are considered significant, that is, those that are associated with above average volume, to construct trend lines and channels. Relative and absolute volume. Absolute volume is not as important as relative volume in technical analysis. It is the change in volume that provides the most information about potential price action in the markets. Many investors prefer Many investors prefer to hold on to losing positions in a falling market in the hope that the positions will eventually rebound to break-even or profitability. These participants are displaying what is called loss aversion bias. Investors and traders have the ability to use house money or profit to further fund new positions in a rising bull market. More investment funds start to market their services in a bull market, attracting more potential investors to participate in the market. Volume distortions. A surge in activities such as arbitrage, program trading, and high-frequency trading (HFT) may also distort and misrepresent the traditional meaning or representation of volume. As such, the volume information that traders use and rely on to read market action may not in fact be totally indicative of true volume action in the classical sense. Volume, open interest interplay. Open interest is simply the total amount of outstanding contracts in the futures and options markets. Open interest is therefore the number of unliquidated long or short contracts. Each contract consists of a long and corresponding short position. These contracts are in a sense still active or open. Open interest increases when a new long and corresponding short position are initiated, and decreases when both the long and corresponding short position are excited. Generally speaking, open interest is interpreted the same way as volume. It is indicative of the level of interest or participation in seeing price rise or fall. Open interest divergence is therefore read in the same way as non-price based volume oscillators. When prices, volume, and open interest are all rising, this is indicative of a bullish market predominantly driven by buying pressure. Conversely, when prices are rising but both volume and open interest are declining, this is indicative of a bearish market predominantly driven by shorts covering their positions and longs leaving the market. For declining markets, rising volume and open interest is bearish and is predominantly driven by short selling. In a declining market, traders should look for appropriate signals to go short if both the open interest and volume are rising, and rapidly seek to cover all short positions when both the open interest and volume start to decline together. Volume versus tick transaction. Volume in the over-the-counter (OTC) foreign exchange (FX) market. Exchange FX market. Many brokers offer tick volume instead of actual volume. One tick represents one trade. Tick volume therefore represents transaction volume. One transaction can be comprised of one contract or 1,000 contracts. Although tick volume does not represent actual volume, there still exists a very strong correlation between actual volume and tick volume may be used as a proxy for actual volume as far as comparing relative levels of overbought and oversold. Breadth volume in the arms index. TRIN advances, declines equals, up volume, down volume. In short, a rising but not overbought tick and a falling but not oversold TRIN represent a bullish signal where the trader looks for an appropriate long entry. Conversely, a falling but not oversold tick and a rising but not overbought TRIN represent a bearish signal where the trader looks for an appropriate short entry. For longer term trading, when tick is oversold, i.e., above its 2 sigma level on a weekly chart, and TRIN is overbought, i.e., near or above the 3.0 level on the daily charts, this signals a bullish scenario and the trader looks for an appropriate long entry. Conversely, if the tick is overbought and the TRIN is oversold, this signals a bearish scenario and the trader looks for an appropriate short entry. Two-dimensional volume analysis. We Two-dimensional volume analysis. We may also analyze volume two-dimensionally via volume by price, volume by time. Volume by time represents the total volume traded over a specified time interval or period. Volume by price identifies the total volume traded at each price level. Figure 6.27 depicts a large volume turnover around the $17 price level in SLV. This level therefore represents a significant support. Notice that this volume information is not obvious from conventional volume bar action. In figure 6.28, we see a lot of volume turnover between $77 and we may also use this two-dimensional form of volume. We may also use this two-dimensional form of volume analysis to locate the most significant support and resistance levels in the market. To do this, we first locate the largest volume by price range. In figure 6.29, we selected the $74 to $80 range as the range with the most significant volume by price. Volume Volume to bar range, spread, relationship. The relationship between bar range, spread, and volume may also be used to forecast potential breakouts in reversals. 1. Narrow range on low volume rest bar indicates a potential for reversal, especially during a strong and rapid up or downtrend. 2. Narrow range on high volume reversal bar indicates a strong potential for a reversal. In an uptrend, price remains confined to a narrow range on very large volume. If the volume represented buying pressure, the range would be much wider. Hence, this is indicative of sellers attempting to take control. It is a bearish signal. The converse applies for downtrends. 3. Wide range on low volume reversal bar indicates a potential for reversal as the large price move was backed or supported by a relatively low amount of participation. It reflects a lack of interest. The longer the price bar on low volume, the more bearish it is in an uptrend and bullish in a downtrend. 4. Wide range on high volume continuation bar indicates a potential for continuation as the large price move was backed and supported by a very large amount of participation, that is, interest in seeing price continue. It is bullish in an uptrend and bearish in a downtrend. Constant volume charts are especially useful for pinpointing reversal bars on high or low volume. Since the volume is fixed, constant volume charts are especially useful for pinpointing reversal bars on high or low volume. Since the volume is fixed for each bar, it will be relatively easy to identify potential reversal bars by just referring to the bar range alone and its height in relation to the rest of the bars. Volume leading price versus price leading volume. Does volume lead price? Most practitioners will agree that without participation, that is volume, price will be unable to move in a significant manner. Nevertheless, technical buy and sell signals need not require much volume for them to appear on the charts. Volume cycles in the financial markets. We may anticipate potential price action using volume peak cycles that occur on an intraday basis in the markets. The intraday volume cycle normally peaks around 1:30 p.m. to 2:30 p.m. GMT. At these volume peaks, price will either reverse or continue, but very rarely remain unchanged. Volume on non-constant time charts as seen in chapter Volume on non-constant time charts as seen in Chapter 3. Some examples of non-constant time-based charts include point and figure charts, Renko charts, three-line break charts. The time axis is not plotted in a linear fashion for non-constant time-based charts. This affects the angle of geometrically based overlay indicators like trend lines, channels, and chart patterns. Equivalent charts are unique. Although each bar is based on a constant time interval, the width of the bars varies with respect to volume. To volume. 6.2 Volume oscillators. There are numerous volume-based oscillators and indicators, with some of the more popular ones being volume-weighted moving average (VWMA), accumulation distribution line (ADL), on balance volume (OBV), Chaikin money flow, Chaikin oscillator, demand index, Herrick payoff index, NYSE up-down volume line. We analyze oscillators for bullish and bearish signals using the 8th standard. Methods of observation. Refer to Chapter 8 for more on oscillator analysis. 1. OBOS overextended levels. 2. Equilibrium and zero line crossovers. 3. Signal line crossovers. 4. Price oscillator divergence. 5. Geometrically based oscillator pattern analysis. 6. Numerically based oscillator pattern analysis. 7. Horizontally based oscillator pattern analysis. 8. Oscillator on oscillator analysis. Price-based volume indicators, the OBV and 8D line. The on-balance volume (OBV) oscillator is simply a cumulative or running total of each period's volume added or subtracted from a running total depending on whether the current period's close is higher or lower than the preceding period's close price. Nevertheless, this does not affect the changes in the relative value of the OBV line. As such, all 8 oscillator analysis methods may still be employed to determine bullish and bearish signals. One major weakness of the OBV oscillator is that the current period's volume is added or subtracted from the cumulative total regardless of the current period's price behavior. Price-based volume indicators. Price-based volume indicators, the Chaikin money flow and Chaikin oscillator. The Chaikin money flow, CMF, is calculated in a manner similar to the ADL. First, calculate the value of the multiplying factor, C minus L minus H minus C, H minus L. Current period's volume. Let this value be S. Then calculate the n period sum of S and divide this by the n period sum of volume. This will represent the n period CMF. Just as for the ADL, create a running total for CMF. The Chaikin oscillator is then calculated by simply subtracting a longer term EMA from a shorter term EMA of the running total. In figure 6.43, we see the Chaikin oscillator generating an earlier sell or bearish signal when compared to the CMF. We also see the oversold levels on both oscillators indicating a potential market bottom in copper. Around the month of October 2011. Non-price based volume breadth indicator, the NYSE. Up-down volume. The NYSE up-down volume indicator is the ratio of advancing volume over declining volume. Being non-price based, divergence is read in the same manner as for volume bar action and smoothed and detrended volume. Open interest indicators, the COT report and Herrick. Payoff index. The Herrick payoff index uses open interest in its calculations. As such, it may only be used with futures and options. It incorporates price in its calculations and, as such, divergence readings should be observed in the same manner as all other price-based volume oscillators. 6.3 Chapter Summary. In this chapter, we have observed how volume and open interest play 6.3 Chapter Summary. In this chapter, we have observed how volume and open interest play a critical role in helping to decipher potential price and market action. We have also seen how price-based volume oscillators are interpreted differently from non-price-based volume indicators. We shall be applying most of what we have learned in this chapter, with particular emphasis on volume divergence and filtering volume action throughout the rest of this handbook.